Most people think target date funds are the safest, simplest choice they can make for retirement. You pick a year, you set it once, and you trust that everything will be handled automatically. It feels responsible. It feels conservative. It feels like the kind of decision that can't really go wrong. But many retirees discover something unsettling much later. Even though they followed the rules, even though they chose the safe option, their retirement still feels riskier than they expected. And they don't understand why. Over the years, I've seen this confusion again and again. Someone sits down, confident they did things right. They used a target date fund. They rebalanced automatically. They never tried to time the market. On paper, everything looks reasonable. But emotionally, they feel exposed. They worry more during market downturns. They feel uneasy about withdrawals. They're surprised by how much their balance still moves. The hidden problem isn't that target date funds are bad. It's that most people misunderstand what they actually do. Target date funds don't eliminate risk. They redistribute it. As the target year approaches, these funds gradually shift from stocks to bonds. That sounds comforting, but what many people don't realize is that this shift introduces a different kind of risk, one that shows up later when flexibility matters most. Market risk doesn't disappear. It changes form. Late in retirement planning, volatility may decrease slightly, but interest rate risk increases, inflation risk increases, and withdrawal risk becomes more visible. This catches many retirees off guard. They assume more conservative means more stable. But stability in value is not the same as stability in income. Target date funds are designed to manage asset allocation. They are not designed to manage spending. And that distinction matters more than people expect. When markets fall early in retirement, even modest declines can have an outsized impact. Withdrawals continue. Balances recover more slowly. And the psychological effect is heavy. This is known as sequence risk. Target date funds don't protect against it. They weren't built to. Another issue is bond sensitivity. As target date funds become more conservative, they rely more heavily on bonds. But bonds are not risk-free. When interest rates rise, bond values fall. Many retirees experienced this unexpectedly. They expected bonds to stabilize their portfolios. Instead, they saw losses at the same time stocks struggled. That combination feels deeply unsettling, especially when withdrawals are already underway. There's also the issue of personalization. Target date funds are built for the average investor, but retirement isn't average. Some people retire early, some retire late. Some spend aggressively, some spend cautiously, some have pensions, some rely entirely on savings. A single glide path can't reflect all of that, yet many retirees assume it does. So they trust the fund instead of questioning whether it still fits their life. Another overlooked risk is false confidence. Because target date funds are marketed as set it and forget it, people often disengage. They stop reviewing allocation. They stop thinking about income. They stop adjusting strategy. Then retirement arrives, and suddenly engagement becomes urgent. That transition is stressful, because the fund never explained how to use the money, only how to invest it. This leads to a common pattern. Retirees hesitate to withdraw. They worry about timing. They feel unsure about how much is safe. Not because the fund failed, but because it was never designed to answer those questions. I've seen retirees who relied exclusively on target date funds feel surprised by how little clarity they have. They ask questions like, why does my balance still move so much? Why does income feel unpredictable? Why am I more anxious now than I expected? Those questions are not signs of poor planning. They're signs of misunderstood tools. Target date funds are excellent accumulation vehicles. They are not complete retirement plans. They don't account for taxes. They don't adjust for spending flexibility. They don't respond to personal risk tolerance. They simply follow a predefined path, and life rarely follows a predefined path. This is why some retirees feel a growing sense of discomfort as retirement progresses. The structure that once felt reassuring starts to feel limiting. They realize they don't know how to adapt. They don't know how to separate income needs from market noise. They don't know how to regain a sense of control. Part of the problem is how target date funds are often presented. Financial advisors and workplace retirement plans promote them as ideal for hands-off investors. And during the accumulation phase, that's often true. Your balance grows. Markets recover over time. Contributions keep flowing in. But retirement flips the equation. Now, you're removing money instead of adding it. Now, market timing suddenly matters in ways it didn't before. Now, you're living on this money, not just watching it grow. That shift is more psychological than most people anticipate. The fund that felt effortless at 55 can feel uncomfortably passive at 67. You're no longer building toward something. You're sustaining yourself from something. And that difference changes how every market movement feels. When a correction happens during your working years, you might even see it as an opportunity. You're buying low automatically through contributions. But when a correction happens in the first few years of retirement, it's different. You're selling into that downturn just to cover expenses. You're watching the balance drop faster than you expected. And even if the market recovers eventually, the money you withdrew during the decline is gone. It can't participate in the rebound. This timing problem is invisible when everything is going well, but it becomes painfully obvious when it's not. And target date funds, by design, don't address it. They don't pause withdrawals during downturns. They don't adjust spending recommendations. They don't offer strategies for riding out volatility. They just keep rebalancing according to the glide path, regardless of what's happening in your life. Another layer people miss is the emotional toll of watching something move that you can't control. During your career, you had income from work. If your retirement account dropped, it was unsettling but not urgent. You knew another paycheck was coming. In retirement, that account is the paycheck. So when it drops, even temporarily, the feeling is different. It's not abstract anymore. It's immediate. And because target date funds still hold a significant portion in stocks even after the target date, that volatility doesn't disappear. It's just reduced. For some retirees, that reduction isn't enough. They thought conservative meant stable. They didn't realize it still meant fluctuating. Then there's inflation. Target date funds shift toward bonds to reduce volatility, but bonds historically struggle to keep pace with inflation over long periods. So retirees face a hidden trade-off: less short-term movement, but potentially less long-term purchasing power. That trade-off might make sense for some people, but many don't realize they're making it. They just assume the fund is optimizing for their best outcome. In reality, it's optimizing for an average outcome across millions of investors. And averages don't account for your specific health, spending habits, legacy goals, or risk capacity. I've talked to retirees who feel frustrated because they realized too late that they needed something more flexible. They wanted to be more aggressive in certain years and more conservative in others. They wanted to adjust based on what was happening in their life, not just what year it was. But target date funds don't bend that way. Once you're on the glide path, you're locked into its assumptions about what someone your age should be doing. That might feel fine if those assumptions match your reality. But if they don't, the mismatch creates quiet stress that builds over time. Some people try to solve this by moving money out of the target date fund and into other investments, but that introduces new complexity. Now they're managing allocation themselves, which defeats the original purpose of simplicity. Others just ride it out, hoping the fund knows better than they do, and sometimes that works. But hope isn't a strategy. It's just deferred anxiety. The retirees who feel most at ease eventually realize something important. They stop treating their investment as the plan. They start treating it as one piece of a larger structure. They ask different questions. Not just, what's my return? But how does this support my spending? How does this interact with Social Security? How does this fit with taxes? How much flexibility do I actually have? Those questions lead to better decisions. Not because the answers are complicated, but because the questions acknowledge reality. Retirement is not a static event. It's a shifting phase that lasts decades. What works at 62 might not work at 75. What feels safe in a bull market might feel terrifying in a bear market. Target date funds can't adapt to that, but people can. This doesn't mean people should abandon target date funds entirely. For many, they are a useful foundation, but they should not be treated as a complete solution. Retirement comfort comes from understanding how money supports life, not from assuming a product will handle everything. The retirees who feel most confident eventually shift their thinking. They stop asking, "Is my fund safe?" and start asking, "How does this fit into my income plan?" They examine flexibility. They examine timing. They examine trade-offs. That awareness reduces anxiety more effectively than any single investment choice. In future videos, we'll explore how retirees manage sequence risk, how income-focused planning differs from accumulation, and how people move from autopilot to confidence. No fear, no hype, just clarity. Because the biggest risk in retirement isn't choosing the wrong fund. It's assuming one fund can replace understanding.